Hello everyone, it's their finale with RMI LLP. I hope you guys are having a fantastic week. Thank you for joining on here with his quarterly one-on-one live to discuss accounting and related topics. And so this quarter, with it being beginning of February, it's an accountant's favorite time of year, and for us it's getting close to personal tax season, so we wanted to focus our discussions around that. But of course, any questions are always welcome. So just going to give it a couple minutes for more people to trickle in here. But thank you for everyone that's joining in. Of course, it's our finale managing partner with RMI LLP. And yeah, if you have any questions, feel free to post them with our initial emails and everything. We do have some that have trickled in, and I'll start with those ones. But keep posting, and hopefully we can get to everything. So as we get started, the first question that was sent in to us was someone had sold 100,000 of stocks in USD and exchanged the US money to Canadian dollars. What is the tax they got to pay from that exchange? And so this is actually a very in-depth question, which I'll try to cover very high level. And basically what happens in that situation is you always need to look at the Canadian tax rate. Or the Canadian pricing. So when you bought the stocks initially, we look at what price you paid in Canadian dollars, and then when you sell it, we look at what price you sold it in Canadian dollars, and that is your capital gains. And so in that instance, you end up paying 50% of that goes into your income, and then that tax on that depends on what your tax bracket is, which could be as low as 0 if you're under the thresholds, or it could go up to, in Alberta, 48%. So basically we don't worry so much about the exchange component. We just look at it in Canadian dollars and what the Canadian equivalent purchase is and the Canadian equivalent sale price is. Another question here was, I want to buy a truck that I'm planning on using later this year for business. Shall I wait with the purchase until I incorporate, or can I buy it now on the personal side and then move it? What are the implications and what can I write off? So really good question there. Basically, there's a few different things. When you have an incorporated company and you're looking at using vehicle expenses, the first thing that I always look at is saying, what makes the most sense? Does it make sense for the company to actually own the vehicle, or should we do something like mileage allowance? So CRA has given everybody a mileage rate, which works out to be about 70 cents a kilometer. And right now, and so in that instance, what we need to look at is, say, if you're incorporated, how many kilometers are you driving? If we're using the CRA mileage reimbursement rate, are we good to go, and does that give you a big enough deduction? The second option is obviously having the vehicle owned by the company. In both scenarios, you need to be tracking your mileage because CRA will come back and ask, what's the personal use, what's the company use. So if the vehicle is owned in the company, but you drive it as your own vehicle, you're tracking your mileage, and what happens is one of two things. One, the portion of expenses relating to personal come back to you as income. And the second piece that happens is there's something called standby charges. And those standby charges end up, it's a calculation done by CRA, and that becomes a taxable benefit for you just for having the vehicle available for your personal use. So sometimes it's better to do the mileage allowance, depending on the nature of the business. Sometimes it's better to have the company own the vehicle, but always something to look at in more detail. And so, yeah, thank you everyone for joining. We got lots of people trickling in, which is amazing. Of course, this is our quarterly one-on-one live with myself, or finale managing partner of RMI LLP. Please write down your questions here. Because it's that time of year, we are focusing a little bit more around personal taxes and questions around that. But any questions are always welcome, as always. So the next question that popped in here was, capital gains rate increase was deferred to January 2026. What does this mean for taxpayers? That's a great question. So a lot of people might have heard about the capital gains inclusion rate being increased. And what that means is that when we have a capital gain in Canada, right now we're only taxed on half of that gain. If I sold stock, I had a $100,000 capital gain, $50,000 goes into my income, and I pay tax at my regular rates on that $50,000. What this increase, the deferral of the capital gain inclusion rate increases, they were planning on increasing this up to 2/3 inclusion. So on the same example, $100,000 capital gain, 66,000 and 66,666 would go into my income, and I would pay tax at my personal rate on that. With the rate being deferred, the increase being deferred till January 2026, I think the indication is that most likely the election would have happened by then, because it has to happen before October, and the new government will be able to decide if they're going to go through with it or cancel it in general. So that one's just wait and see. Let's see what happens before we have to make any changes and assume that it's happening again. Another good question here. Are there any changes to the list of eligible medical expenses, and how do I calculate the amount of medical expenses I can claim? So this one, I'm going to keep it very high level. There is on CRA's website, if you look up CRA medical expenses, they give a thorough list of everything that can actually be claimed. So things like the stuff that has come up more recently is like fertility treatments is in medical expense and things like that. And so on your medical expenses, what you can do is you gather them up for the whole year, and your 3%, the first 3% of your income is non-deductible up to about $3,000. It's just around that number, and anything above that can be claimed. So for example, if you made $100,000 as income, let's say your first 3%, so $3,000 is not deductible. And so if you have $10,000 of medical expenses, $7,000 becomes a credit for you on your taxes for the year. But anything specific in that relation, I would say check out the listing on CRA's website, because they have a very thorough list. But in general, the way I always say is anything that is for medical treatments, prescriptions, anything coming from a doctor typically is a good deduction. Can you explain the difference between RRSP and TFSA from the tax point of view? Oh, I love this question, and those that have heard me talk know I'm very biased on one of these, especially for entrepreneurs. So what we got to look at in this scenario, RRSPs are a great vehicle for those that are in high income tax brackets. What happens is you end up getting a deduction up front on that, and when you take it out, you get to pay income tax on it. So the theory behind it is I'm earning high income today, I'm going to get a deduction on a higher tax bracket. When I retire, I'll be in a lower income and I'll take that out. Now for entrepreneurs, people with holding companies, things like that, sometimes you're forcing a higher income for yourself to get the tax benefit. And what you're doing is you're locking your money into a vehicle that is very regulated. So it limits what you can invest in. You're forced to take it out at a certain age, age 71 by CRA. And the other big thing is you don't get the capital gains treatment, but you do get a tax deferral on that income. So RRSPs are a great vehicle, but where I don't like them is when people aren't in a high income tax bracket. And I see them get overused here. Because you don't need that deduction necessarily today if you're not in a really high tax bracket. So the TFSA comes in, and the TFSA is after tax money that you can put into the registered account. And the best part about this is the TFSA, any growth on that investment is tax free. And so you can pull that out and you can reinvest it again in the future. So it is a very good vehicle to use that I tell most people, make sure you're maxing that out. The other big thing is your RRSPs, when you pull it out, it goes in as income. So when you retire, a lot of your government benefits are attached to income. When your TFSA, when you pull it out, you actually don't end up, it doesn't hit your income. And so another huge advantage when it comes to retirement and benefits on that side. So yeah, thank you again for everyone that's joining. We got a couple more questions coming in here. So how much income between dividends payroll can I take out from my corporation without paying any taxes personally? That's a great question. So if you're on payroll, you have to remember the CPP component. So the first $3,500 you can take out without any CPP. From $3,500 up to $15,000, you're still stuck paying CPP, but no tax on that. When we're talking dividends, you don't have to actually take out CPP. So if you're talking ineligible dividends, you end up taking out, you can get about $25,000 or so without any tax. And eligible dividends, you can actually take out about $75,000 without tax. The difference between the two comes in for those that are not familiar with those terms, ineligible and eligible dividends, the difference comes into how much tax you've paid in your company. If you've paid more tax in your company, you're able to take the eligible dividend, which will be less tax on the personal side. Next question was, what about educational expenses? Is there any changes? So on that one, there's a few changes. There's changes a few years back where the textbook allowance was denied or taken away, and so you can still claim your tuition. That still applies, and so if you're taking any university level classes and you're paying tuition, that you would get a slip for, and you can claim that as a tax credit for a tax credit on your taxes as well. So that there's not been any changes in the last year on that one, but there was some that was done a few years prior. Next question that came in here, is there a limit to charity donations I can make? So charity donations are a great way to save taxes. After on your first $200 you get a 15% tax credit. Anything above that you get a 50% tax credit, so quite a significant deduction that you can claim, but you can only claim up to 75% of your income. So for example, if your income was $100,000, you can have up to $75,000 as a donation for the year. If you did donate more, you can carry that donation forward. So it's not like you will lose out on the limit, but it'll just get carried forward and you can use it in future years. Next question here. There was a significant expense for my rental property in 2024. If I'm considering selling the property in the near future 2025, should I hold off claiming the expenses for the 2024 filing? Good question. And the thing is, we shouldn't really be looking at when to claim the expense because it was a 2024 expense, but what the nature of the expense relates to. Okay? And so there's two things here. One is what we call repairs and maintenance, and one is what we call a capital item. So what's the difference between the two? Well, on a repair and maintenance, think about it that you have paint on your walls, they're scuffed up, you're repainting it, you're cleaning it up. There's no real capital improvement in that instance. Another good example that I use a lot is, imagine you're changing the roof on your property, and let's say there's damages, and so you're using grade A shingles and you're putting grade A shingles back on top. Well, that would be more of a repair and a maintenance item versus what we consider a capital item. If you had shingles and all of a sudden you put on a metal roof, you've improved the property. And that improvement we call a capital asset or capital improvement. And so the treatment is very different because the repair and maintenance you get to write off in that year. And the capital improvement, what happens, it actually goes against the cost of the property. And what happens is when you sell it, it will reduce your capital gain. Now that there is a big difference there because your repair and maintenance you're getting 100% deduction on, but your capital improvement, because we only pay taxes on 50% of our gain, you're actually not getting the full tax deduction. So repair and maintenance item is a lot more lucrative from a tax deduction standpoint, but that's where you have to be careful. If it is truly a capital improvement, CRA will be flagging that if it's a big repair item for the year, and they'll ask to see the backup and do their own verification to make sure that it is treated properly. Once again, it's Irfan with RMI LLP. Thank you everybody for joining. This is our quarterly one-on-one on Instagram Live, and please write down your questions here. Again, we're focusing around personal taxes with that right around the corner, but all questions are always welcome. And so let's see, some more have come in here. I have a loss on my crypto investments. How would that affect my taxable income? That is a great question. Crypto is a whole nother venture in the taxation standpoint, and we've seen some changes come about from what CRA is doing to be able to track this better. And so on crypto, there's two different ways you can treat it. So one, if it's a long-term investment, so for example, I bought Bitcoin in 2010, I'm still holding it, and I sell it off in 2024, that's a capital gain. So no different than you having a capital gain on your stock, okay? Now we're talking about losses here. So if you ended up in a position where you're a long-term hold and you had a loss, it would be treated as a capital loss. Capital loss you can only take against other capital gains you might have income on, okay? The second type of treatment on crypto specifically is it could be considered regular active income. So some people are very active in crypto, doing thousands of trades, trying to make some money, and they're very active in that space. Or for example, there's things like staking, mining, all of that kind of stuff, which is considered active income as well. And so when that happens, if you have a loss, it will go against any other income you have. And if you have a gain on that, that goes in as regular income and you don't get the capital gain treatment. So it's very important to understand what is the type of income you're earning, what's the treatment of that income, and then you can apply it accordingly. In this case, when you have a loss, the same thing applies, because a capital loss gets treated very differently than a very active regular loss as well. Let's see some other questions coming in here. The next one that I have that somebody had sent in was, I took some online courses to upgrade my skills this year. Can I write those off even though they weren't through a traditional university or college? You got to be careful, because typically we need to look at saying, are you getting a tuition slip from it? So sometimes what will happen is there will be some that you do outside of Canada. If they are registered in Canada, they'll still give you a tuition slip and then we can claim it. If it's just a traditional, hey, I went and took a QuickBooks course for learning, if you don't have any business income or income specifically relating to that, then you can't claim it. The other good example, a lot of people enjoy investing in real estate. So if you take real estate courses, can you write them off? You can, as long as you got some type of real estate income against it. So it's always something to consider. When I started out in my real estate career, I did some courses, and because I launched a real estate business right away, I was able to claim them. I had losses for the first couple years, but once I ended up starting to make some money, I was able to actually offset that income with some of those expenses as well from the past. So it's very important to understand where the courses are and how we want to claim them and what they're in relation to. A lot of times those can be claimed better against business income versus just your regular personal income, because it's very difficult to claim courses that aren't through a recognized university against that income. Here's another question that came in. Can trucking license fee be claimed under personal taxes? So the answer is yes, if you've got trucking income against it. As well, you might be an employee, but you're required to incur that licensing fee. So then you can write that off against as part of like your employment expenses. So there are ways to be able to make sure you can get that deduction. Sometimes you will need some extra forms from your employer, for example, a T-2200, which is to claim employment expenses. And if you have that, you're able to write off expenses that you're incurring in order to earn the income you have. If you're doing it as a business and you've got business income, then it can be written off of, against that as well. Some good questions. Thanks for sending them in. Here's another one. If I incorporate, should I pay myself a salary or dividends? Great question. I get this all the time. And I tell people it really comes down, in my opinion, to three things: RSPs, CPP, and childcare. And so each of those I'll go through quickly here. So the first one is childcare. If you're taking dividends and not employment income, you can't write off childcare expenses. So it's important to understand between you and possibly a spouse what that can look like and how much you're spending there, because it might make the decision for you. The second one is RSPs. Some people really like to invest in RSPs, and if you want to keep increasing your limit, then you need to be on salary, because if you're taking dividends, you don't see an increase to your RSP room for future contributions. And the last one I was saying was CPP. So when you're on salary, even if it's your own business, you are required to pay into CPP. CPP today, as an employer, you end up paying both sides. So the employee portion and the employer portion. In today's dollars, you're looking at about almost $9,000 a year of expense at the maximum rates. And so some people say, I want to invest in CPP. I want to make sure I've got that safety net when I retire. Others say, you know what, I don't want anything to do with the CPP fund. I will save for my own retirement. And so for those ones, you can take a dividend. If you want to pay into CPP, then going on salary is the best way to do it. So those are the three big factors I always look at. Next question here, what should a business consider if they are working out of their home? Are there considerations from a tax or accounting standpoint? Absolutely. So the first big thing is if you have a business that you're running from your house, you're able to write off a portion of your house, and that's key for sure. So we call that home office expenses. So based on the size of your office at home and the space you're using, some people might be using some additional space for storage or different things like that. We can take a portion of that expense or a portion of the size of the property versus your office versus the whole property, and that percentage of your mortgage interest or rent, utilities, property tax, insurance can be a write-off against the business income. So very important to make sure you're always factoring that in, because it can be a substantial deduction and of course help save you some tax dollars there. Another question here, what are the benefits of being incorporated as a small business, tax or accounting wise? The biggest benefit, it really doesn't come down from a tax perspective, doesn't come down to what is inside your business, but it's what you can keep in your business. And so if you end up coming to me and saying, hey, you know what, Irf, I've got a great business, I'm a sole proprietorship, I make $50,000, I want to incorporate. First thing I'm going to ask you is say, okay, how much money can you save in your business? And if you say, well, I'm going to make 50 grand in my company and I'm going to pull it all out. I'm going to say, okay, well, let's look, does a small business make sense in an incorporated company? And the answer might be no, because once you take the income out personally, you're still paying your personal tax rate, so you don't save anything. Now, if you can save money in your corporate structure and reinvest it, do other investments with it, you only pay 11% on the first $500,000 of profit. And where you got a big benefit of that, our personal rates are typically 30 to 40% on average. So that difference, you end up actually being able to save quite a bit of money, which gives you more pool to invest back into your business, into other things, and continue to grow it further. But the other factor you always have to consider with incorporating is liability. So if you do it as a sole proprietorship, you have to remember it's your house, your car, your personal assets are on the hook if anything goes wrong. Inside of an incorporated business, it's what's inside the business that's on the hook. So as long as you're not doing any fraud or negligence, they can't come after you personally, which then protects all your personal assets as well. So there's a few different factors to always consider there. Some more questions. Thanks for keep sending them in here. Can I defer my capital gain on sale of property? So this is a common question I get, and it's mostly coming from the US actually, because in the US they have something called a like-kind exchange, where if I have a 3-bedroom, 2-bath house and I sold it, but I sold it to buy another 3-bedroom, 2-bathroom house, I can defer my capital gain. Unfortunately in Canada, we don't have anything like that. So the only way to defer your capital gain in Canada is you can do it for up to 5 years if your payments on the sale are coming in over 5 years. So for example, I have a house, I sell it, I finance a portion of the house for the buyer, and they're paying me over the next 5 years. I can defer my taxes by 1/5 a year. You have to take at least 1/5 a year in, and over 5 years you claim your whole capital gain. So unfortunately, we don't have as great options like you do in the US on that standpoint, but there are still some mechanisms that sometimes make sense and get used. Next question here. So my business is currently funding courses and traveling expenses, but not generating income. How long can I take losses in the business? So great question. CRA does not specify saying you can only take losses for a certain number of years. But what happens is if you have losses for too many years, CRA comes to question the validity of those expenses. Because CRA's mandate as a business is in business to try to make profit. Keyword being try. So if you're investing in courses for 2 years and those courses are part of a greater business plan that you're going to start to see some profits, then that's okay, because then once you start making profits, those expenses will still apply and carry forward. So really there's no set timeline around it. But typically I'd say you want your business to start generating income within a year or two, so then at least you can show that, hey, I did this course because I'm trying to make a profit and I'm trying to earn a living, and therefore I can write off those expenses against the income I have coming in. Next question. So what expenses can I deduct as sole proprietor versus incorporated? Great question. I'd say most of them are very similar, to be honest. So there's not too many differences in terms of what can be claimed, because they're both types of businesses. So you can write business expenses off against it. What I tell most people is our Canadian Tax Act is very subjective in nature. There are some very specific rules But for the most part, high level, you can say that whatever I need to spend money on to earn my income in my business, I can write off. Now, that doesn't matter if it's a sole proprietor or incorporated. There are some caveats. For example, under a sole proprietor, you're typically using your own vehicle, so you can only write off a portion of the vehicle expenses. In an incorporated business, you can do what I had mentioned earlier about claiming mileage. So there are some very specific things like that. Another good example is in a business, you can write off your home office expenses. As a sole proprietor, you can only write off your home expenses up until the point of zero income. If it puts you into a loss, they'll carry forward and you can't claim them. So there are some very specific nuances, but in general, think of them both very high level. As if I need to incur an expense to earn income, I can write it off. But of course, check in with an accountant to make sure you're not claiming something that puts you offside. Next question, can we claim home office expense as employee? Any requirement? Great question. So if you do work from home as part of your employment contract, you can get a T2200 from your employer. This would say that yes, you are required to work at home, and then you're able to write off a portion of your expenses as an employee as well. So that form gets picked up on your personal tax return. You write off a portion of your expenses, and you get that extra deduction. Next question, what do I need to give my accountant for my crypto tax filing? Great question. So what I tell most people on this standpoint is crypto, it really depends what you've done in the past, like what you've done with crypto. Are you active in nature? Are you doing it more from a capital gain standpoint? Is it treated through a company? Is it treated personally? And how much trading have you done? But the main things you need is some way to be able to track your profit or loss on each transaction, including the transaction fees. There are some really good softwares out there that do this today. That you can link to your exchanges, and they'll pick up a lot of the data. You have to be careful with those softwares because a lot of the times they don't know where it went if you're transferring the funds out. And so you need to be able to go back and clean up that data, or that's sometimes some of the work we'll do. But in general, you need to be able to account for your profit and loss on every trade that you've done. You can imagine it's very easy to do thousands of trades, so it can become very cumbersome, and that's when I'd usually recommend one of those softwares. Is there anything in Canada like the US 1031 exchange? That's the like-kind exchange on properties, and so no, there's nothing like that in Canada, unfortunately. If you are in the nature of real estate, there may be some ways that you can do that using the capital asset piece, but it becomes very tricky and it's to a very limited number of people. But in general, in the US, it's much more common to be able to use something like that, while in Canada, you don't get that option. What are some ongoing costs of running a corporation? Great question. The big one is obviously your filing fees. So the things that you got to be paying attention to is every year, wherever your company is registered, you need to pay to keep it active with the government. So for example, here in Alberta, you'd pay to keep your corporation active on an annual basis. The next one is, of course, your bookkeeping. So if you're doing your bookkeeping yourself, great. Usually there might be a software involved, such as like QuickBooks Online. And so you've got that cost. If you're paying somebody to do your bookkeeping for you, you've got that additional cost. And then you've got your tax filing costs at the end of the year. A lot of people are able to do their personal taxes on their own. There's softwares for that, and they're much simpler. When it comes to corporations, I would recommend using an accountant. They're more complicated. You want to make sure you have the right structure and the right setup as well. And then and that would be another cost that you have. Of course, the other thing when it comes to business, your banking fees are higher. Anything you do tends to be a little bit higher. Insurance costs are a little bit higher versus personal. So it just tends to be, you gotta watch those expenses for sure. Next question in here, can I claim school tuition if it's part-time school only? You can, so you'll still get your tuition slips. That goes in as a deduction for you, and it goes against your regular income. So absolutely, even if you're in part-time school, you can claim that as a deduction, which is great. I paid fees to a financial advisor. Are those tax deductible? Absolutely. So if you have any investments and you're earning investment income, any fees to a financial advisor are tax deductible, which is always nice, especially against any investment income. There are very specific things. Your tax filing fee can be claimed against rental income, or if you've got investment income. One that many people don't know about is safety deposit boxes. You can write off those fees as well, which is a nice little added benefit too. So once again, it's Irfan Ali Moladina with RMI LLP. Thank you everyone for who joined today. I hope I was able to provide some value and answer some questions. As always, if there's anything I haven't covered or any new questions that come up, feel free to reach out to our office anytime. We're always here to help. But thank you very much, and we'll see you in a couple months.